morning, everyone. My name's Richard Dale. I'm the FMD advisor in Adelaide and Investment Committee Chair, coming to you from the FMD offices in Adelaide, and I welcome you to a special briefing we have for you today. Firstly, I'd like to begin today by acknowledging the traditional custodians of the land on which we meet and pay my respects to the elders past and present. We'd like to welcome all our valued clients from around the country, wherever you may be connecting with us. Today is a very special briefing, an opportunity to hear from one of the country's most well-recognised and respected investment managers, Hamish Douglass. Hamish is co-founder, chairman and chief investment officer of Magellan Financial Group and lead portfolio manager of Magellan's global equity strategies. But before we begin the formalities of this morning's briefing, I'd like to take this opportunity to welcome key members of our team, the FMD Investment Committee. So in addition to myself, we've got other members online, including Martin Hawkins, advisor and investment committee member in Brisbane, Adam Davenport and Mike Reynolds, directors and investment committee members based in Melbourne. So back to formalities. It isn't often that we have the opportunity to present an investment manager of the likes of Hamish Douglass to our clients. So by way of background, Hamish is co-founder of the Magellan Financial Group, an Australian group that has successfully grown from a startup back in the mid-2000s to a manager with over $110 billion in assets under management. That's an impressive feat indeed. Hamish leads a team of investment professionals operating global equity and infrastructure strategies. Magellan strategies are highly rated by the research community in Australia and overseas, and Hamish and his team have received multiple industry awards. Hamish is a former member of the Australian Government's Financial Literacy Board, the Australian Government's Takeovers Panel, the Australian Government's Foreign Investment Review Board, and the Forum of Young Global Leaders World Economic Forum. Hamish is also a director of the Victor Chang Cardiac Research Institute. Today, Hamish will provide insights into recent performance of their flagship strategy, the Magellan Global Fund, a strategy that over the longer term has achieved a return of 12% per annum since inception back in July 2007. Although the Global Fund has found the recent strong markets a challenge to keep up with, the annualised return is still 3% per annum ahead of the broader market index. We'll also discuss key positions held within Magellan Global Fund, and Hamish will also comment on the relevant facts addressing some of the media headlines relating to the Magellan Group you may have seen. So look, Hamish, let's begin by looking back to the last year and a half. What a year, hey? So can you please provide some background on the strategies, the performance and the, I guess, relative underperformance compared to the index? And the Magellan Global Fund has had a defensive stance heading out of what was a very uncertain world when we look at back in March last year. With COVID, the spread of virus, lockdowns, economic stimulus, all the things that happened through there. And so markets have rallied strongly. Hamish, are you still taking a defensive stance? And if you are, how are you participating in the market?
Yeah, well, first of all, I'd say, Richard, it's important for people to really understand what we're seeking to do with the strategy. And our strategy has and from day one has had two very clear objectives. That's first of all to earn people an acceptable rate of return on their capital through the cycle. And we've set a return objective of 9% per annum through the full cycle. And as you said, we've delivered over 12% per annum. And nothing has changed in the last 12 months that is diverting us from that objective. And the second objective we've always set out to do, and this is incredibly important, and you've asked a question on defence, and that's downside protection. At the end of the day, we want to have a strategy that has materially lower downside risk than markets. In the last 12 months of having something with less downside protection hasn't been as good as having the market. The strategy's actually delivered more than its 9% long-term objective in the last period, but it's always got an element. It's half its portfolio is in assets that are inherently very defensive. We own 12 investments in businesses like Nestle and Procter & Gamble and Reckitt and some utilities and Novartis. Those assets have delivered 7% returns in a market that's up nearly 30%. Through the last 14 and a half years, those assets in half our portfolio have delivered 8% per annum and have materially less risk than the market. And if I took you through the results of Nestle and Procter & Gamble and PepsiCo and the utilities, and we just ignored the market for a moment, you would just be very, very happy that you have and your clients have your assets invested in some of the best businesses in the world with very, very low risk. And the issue is that the tide goes out. And when the tide goes out, you're going to find out who's swimming naked, and your capital is safe in those investments. And just because they went up 7% and not 30%, nothing detracts from the fact that it is very in your client's interest to have a core holding of those sort of very, very defensive assets in the portfolio. We also have other assets that we're famous for. Things like, Alphabet, and now we're in Amazon, and we've been in Netflix and Microsoft. We've made 10 times our clients' money. They're great businesses, but we offset the risk with having some downside protection. And what happens is when the tide goes out and markets self-correct, if people want to have income and assets go down a lot, it is very, very expensive for people's future capital and returns to be taking their income out of capital when markets are down. It's something called sequencing risk. And our strategy that has literally, not literally, in every major market downturn, our strategy has been amongst the very best in the world, and it's because it has lower risk. And actually in March last year and April last year, our strategy was well ahead of the market when things really went wrong. And every time it's gone wrong, I'm not guaranteeing people, but we have a lower risk strategy. So am I worried that we have half our portfolio in assets that have lagged the largest cyclical rally we've actually seen in 50 years? There's nothing going wrong in any of those assets, and they're going to continue to protect and I think continue to deliver very satisfactory low risk returns for people in that. We had some issues around. I was probably too cautious and not taking enough risk on just before the vaccines. Also, we had some investments in China, and China's been a tough place in the last 12 months. We've corrected that. We hold less in China, but we haven't lost our nerve on China. So people have to ask themselves the question: do they want a strategy that is going to give them, I think, very acceptable returns over the cycle with lower risks? We are custodians of people's money, and I understand that. At the end of the day, we are sticking to what we do, and that is looking after people's capital with low risk and getting them acceptable returns on their capital. And I'm not going to react just because my ego's taken a dent in some newspapers. And frankly, we're driven by some very people who are either competitors or other people who are trying to create an atmosphere that we're not. We've beaten the markets for 14 years in a row, and we've had one 12-month period in one of the most extreme events in history where being defensive hasn't looked good. But as I say, as Charlie Munger said last Friday, he thinks this is the most extreme market conditions since 1999, and even more extreme than they were in 1999. The tide will go out, and we'll see who's been swimming naked. And all I'll say to you is the movie hasn't finished yet. We're at intermission and it looks like we're lagging. Wait for the movie to finish, and we'll continue doing our jobs, and we're not going to chop and change because of my ego here. We're doing things that we believe are right. We're invested in great businesses that have very high probabilities of getting good rates of return on people's money. And that's what it's about. People don't retire on some relative to an index return. They retire and they live in the future, and what they can leave to their children is all about the rate of return they get and whether they take an acceptable level of risk. And we take materially less risk than the markets, and that hasn't been a fun place to be in the last 12 months. But we're not going to get caught up in envy and everything else. As I say, we made a bit of a mistake around China, but they don't repeat themselves. I said we, I use I. Whenever there's mistakes, I take full responsibility. when we get things right, our team is fully responsible for that. So, if I showed you the results of every company we own in the portfolio, actually their earnings have grown faster than the market in the last 12 months. We have much less leverage than the market has. We have much higher returns on capital in these businesses. If this was a private equity portfolio, I suspect you would be skipping down the street getting a review of every company we own. They're just an outstanding collection of businesses. It's just the market hasn't rewarded quality and lower risk in the last 12 months. And I just have to accept that. I just read the newspapers and, it's tomorrow's fish wrappers at the end of the day. I hope people don't get caught up with some of the lines people are trying to push. We are very, very mindful that it's not our money. It's all of your money that we're managing. And I'm not about to go and lay on some risk at the moment, trying to protect my own ego. I can deal with that, but I cannot deal with taking risk I shouldn't be taking for people.
Thanks, Hamish. You made a number of pertinent points, and risk and return is key in our thinking as well, the investment committee. Not in the media's eyes, but certainly.
Well, the media doesn't even understand what we do, and it's simply not even interested in listening to what we do because it doesn't actually suit the story.
But back in March last year, definitely when the investment committee here went through all the underlying investments, including the Magellan Global Fund, we were provided with a good risk outcome, Hamish. So at the moment, like the point you made about Charlie Munger from Berkshire Hathaway, always saying everyone swims with the tide, or the clock's there until the hands drop off.
Yeah, and it's interesting, Richard, in markets which we've been going for 15 years, we've had some really interesting markets because it was just before the GFC struck. And actually, we've had some very, very big downside events during that period. We've actually had as equal outperformance on the downside of protecting people that we had underperformance on the upside here. I suspect that the side on the downside is more important to most people than delivering a 10% return instead of a 28% return or whatever the numbers have been in the last 12 months. Is there a few things we could have done somewhat better? Absolutely. We could have, but we're not losing sight of what we're trying to do, and that's look after your clients' money and get them a decent rate of return. And I think over time, our return objectives will beat most markets in the world over the long term, as it has in the past.
Thanks, Hamish. I will come to some of the pertinent and stock positions in China eventually, but what I'd like to do, because you did mention about media company issues, etc., if we could just address that. And I guess what we looked at is FMD as a business also has looked at what Magellan has been doing as a business over the last few years. Obviously growing strongly, $110 billion under management, but also the business as well has taken, I guess there's been a number of different investment structures which have Magellan has developed: unit trust listed funds, core funds, future pay, in addition to the flagship global and infrastructure offers. But also the businesses has a substantial interest in an investment bank, Barrenjoey, plus direct ownership of stakes in other private companies. So we as an investment group have looked at that, and we said, well, the business now is certainly much larger and more diverse than what it was a decade ago. A lot's happened. And with that, I guess there is a lot to manage, Hamish, in the business. And I guess recently then there's some press about your CEO, Dr. Brett Cairns, leaving, but he's been with the business for some time. And there was also that announcement about your personal situation. With all that backdrop, would you be able to let us all know today, provide some insights into your role at Magellan, how it's changed over the journey, and how your time and effort on the global investment strategies is spread?
It's very interesting, Richard. People have seemed to have forgotten that I used to be the chief executive of Magellan, and actually all the finance and compliance operations and all the building of the business really used to report to me entirely. And a number of years ago, Brett was the executive chair and I was the chief executive, and we swapped those positions around, and a whole lot of reporting lines moved away from me, and they moved to Brett. So actually, things I did 5 and 6 years ago, I've got far less on my plate on a day-to-day operational basis than I had 5 years ago. And it's interesting, 5 years ago, no one was asking the questions. I was up in the middle of the night rewriting compliance policies sort of 6 years ago and reviewing all that stuff. I don't even sit on the main operating board called Magellan Asset Management Limited today. And I did that so I could really focus almost solely on my role as chief investment officer. And it's true, we've taken a number of investments in the past year, but we've been very, very deliberate in taking investments that we literally have no management input at all. You know, Barrenjoey and FinClear are two of the investments we've made in the last 18 months. I've never even been to their offices. And no one in the investment team has ever met anyone there. Our team, led by a guy called Craig Wright, did all the due diligence. Of course, I got presented the papers around that. I'm chairman of the board and I signed off on that. But that would have taken me a few hours of going through the detail and asking some questions around that. After all, I am an investor. I think I can contribute at the board level there. But we have one board director on those companies, and we've written a check. Why are we doing that? Because I think it's in the interest of Magellan, its shareholders, and frankly, all its clients to, in a very sensible way, diversify our business to ensure we're a fortress. Whatever goes on, obviously we're under some attack at the moment, but we want to make sure none of those things actually in any way affect our ability to retain and hire outstanding people here at Magellan. We've launched Future Pay. That was done by a separate person from our investment team, Paddy McCrudden. Brett had worked with him as well over the last 3 years. They're effectively clients of the infrastructure and global equity strategy. You know, nothing happens. They just sign up and have become a client of our business. So I can assure you there is no one on the investment team that's had any involvement in these areas. And actually, 3 or 4 years ago, I dramatically freed up my time by stop being the chief executive. But we do have a business. That's why we want a chief executive being separate, and we've appointed an interim chief executive, and we will have a chief executive full-time as we had in the model in the last 3 years. But I can assure you it's not distracting my time, and no one on the investment floor is involved in any of the things you really mentioned at all. Core series, yes, that's been done by our head of research, but we've had a core infrastructure strategy for a decade. It's been highly successful. So having a core global equity strategy, which is kind of systematically managed, is actually intellectual capital that was developed in infrastructure over a decade. And in relation to Brett, you know, obviously I'm limited, Richard, in what I can say. There's been a lot of speculation that there somehow was a massive falling out between Brett and I. Nothing could be further from the truth. Brett and I haven't had any falling out at all. It's, you know, people should read a little bit into it that, you know, a chief executive has resigned suddenly at the end of the day. An interim chief executive has been appointed, who was effectively our CFO and our COO. Kirsten Morton is absolutely outstanding. She ran a lot of the back office stuff anyway. So there's no sort of continuity risk there at all. I'm disappointed Brett has left. He's done the right thing. You know, at the end of the day, his resignation was for a reason. He's done the right thing. I fully respect him for the decision he made. You know, I wouldn't have chosen it would have happened right at the moment, but the circumstances arose. He made that decision, and I respect the decision. But you know, I can't go into the details behind it, unfortunately. But it is. Internally, all I would say is people have reacted positively to the change and respect Brett's decision in relation to it. So,
okay. So the focus of the,
but I'm not about to become the chief executive again. Take my time. I've been doing that.
Right, you've got enough on your hands. But as far as the team, the investment team, you're saying there's not a distraction. there on the tour?
They're actually on a completely separate floor. The investment team and I sit on a different floor in the MLC Centre to the team that looks after this. They've had no involvement at all in relation to any of those three investments that the group has made. There is a person who heads up that group called Craig Wright under Magellan Capital Partners, and I could count it in the hours in terms of the time over 18 months I've spent on those things of reviewing some investment papers that go to the board. I think in total on FinClear, I've probably spent 2 hours in my entire life on FinClear. Barrenjoey, as I said, I've never even been to their offices. The whole thing about these investments is we want other people to run them. And, we've got a few people who are not investment personnel who sit on the boards really as observers of our investments there. And, we do judge investments. I think we've made 3 wonderful investments that will generate enormous amounts of value for our shareholders in a way that doesn't distract anyone. And, if we do that, we make our business stronger, and our business being stronger is in the interest of our clients, provided we don't get distracted.
Okay. So original focus was on funds and a funds management business, but like you said, you used the words fortress, was it, to diversify?
Yeah, I don't think it takes anyone a genius to work out. We've got a huge amount of our business totally dependent upon me, and it's not I'm not about to go anywhere, but it's not in the interests of staff or even clients to have a business that's completely dependent on one person. And what we don't want to do is just go and launch lots and lots and lots of strategies of trying to diversify. That puts enormous pressure on our back office and our trading and our compliance and other areas. We're trying to do things very sensibly, that we do things to improve the resilience of our business, which is the interest of all our clients and our employees, with a way that doesn't distract anyone, And at the end of the day, we're an investment house, and I think we have some capability to judge whether something's a good investment or not. I think we've hit 3 winners. And it was really interesting, Richard. They were all private investments. None of those companies spoke to anybody else other than Magellan.
Okay. Thanks, Hamish, for expanding on that. And look,
we're not about to do anything radical, Richard. People should just relax.
Right. I think this is a lot of press, and I guess even before the press came, we were just asking ourselves as an investment committee, is there any distraction? And I guess you've answered that question. So we move on. We'll move on.
Do I look distracted with all the stuff that's been going on in the last few weeks? I can tell you, not even that is distracted to me. So I'm not someone who gets easily distracted, Richard.
Good to hear. We move on to the portfolio again, and you mentioned about China before, and a little over a year ago, there was the policymakers in China made some decisions that really impact on a range of listed businesses over there. Can you provide for the audience today some insights into the portfolio's reaction to these actions, and share some insights into some of the research analysis going on in China and Western relations, and further, what's Magellan's view on investing in these companies in the future? A lot of people want to know that. Hamish?
Yeah, well, I'll get my crystal ball out for you, for you, Richard. The first one I started at a high level is, why are we interested in China? It's complex, and why are we interested? At the end of the day, in a world moving forward, it appears with house prices going crazy and money sort of raining from the skies at the moment, the world suddenly changed. The reality is in 18 months, we're going to find out the world hasn't changed, and that we're in a low growth world ultimately. Whether we have a major event during this sort of cycle, I don't know, but we want to have half our portfolio invested in areas that we think have structural growth with duration. It's why we invested in Visa and MasterCard. It's why we invested in Netflix. It's why we're in the great business like Alphabet of the world. It's why we're in things like Intercontinental Exchange. But we don't want to have all our portfolio and things like that. But it's also why we're in a number of China-related businesses like Starbucks and Yum Brands and Alibaba in the portfolio. Because when you think about that, we're looking for businesses that can grow their revenues in that part of the portfolio at least double world GDP growth for at least a decade. So let's peg that at 8% per annum revenue growth for a decade on average. And most of these businesses are growing well above that currently in that, but a decade's a long time. If you think about China, China has gross domestic product or national income per head of around 14 or 15,000 US dollars. Australia and America and Canada and the UK and Japan, we're all at sort of $55,000 to $60,000 per head. So 4 times the amount of that the Chinese have. We are saturated. Once you get to certain income levels, everybody has a television. Most people have a car or mode of transport. Most people have some form of housing, either rented or owned. We all have dishwashers and hairdryers and multiple pairs of jeans and shirts and everything else. China has 600 million people who don't have a lot of those things that nearly most of our societies have at average levels of income. So if our national income per head or national consumption income per head is growing at sort of 4% per annum, it's inevitable that as people continue to be lifted out of poverty, and China has had one of the most remarkable track records in history at doing that, and all their policies are actually aimed at doing that, over the next 10 to 20 years, as those consumption occasions get satisfied of those 600 million people, it's inevitable that their consumption per head is going to grow materially higher than 4% per annum on average over a long period of time. So we've said is that's really interesting. So we've looked for consumption stories in China as part of our portfolio, not to dominate our portfolio, to be something. We started out with things like Starbucks and Yum Brands that we're very well known for, but we didn't want it all in American brand risk in China, because there's something called Taiwan, and there's a little bit of tension between the US and China, if nobody's noticed, a little bit of tension between Australia and China. We know those geopolitical tension. So we diversified by owning some technology platforms in China. And what I got wrong there is I got a position sizing and we aggregated platform technology risk too much in China. And we have corrected that. We have changed our risk controls. We've got less than 4% of our portfolio now in platform technology, but we haven't lost our nerve in relation to that. And we think China is still investable, but you need to have caution and you need to have very good risk limits around what you do. And there's a whole series of risks in China, and I'd break them into 4 sort of risks, Richard. The first, I would call it just the international geopolitical risks. There is enormous tension between the West and China on a geopolitical basis. I call it the Taiwanese risk. So if China ultimately wants to take Taiwan, we're going to have a big issue. I don't think we're going to have a military conflict ultimately over that, but that would be a judgment. But we're going to have a very serious international tension risk. And if you have all your money in your portfolio in something like Starbucks, we've got a very modest position, or Yum Brands, they could be banned in China or something happens to those businesses. So we're watching that sort of Taiwanese risk. The Chinese are actually being incredibly accommodating to those businesses at the moment. We spend a lot of time looking at that risk. We use some of the very best consultants in the world. Michael Morrell, who was the former deputy director of the CIA, advises us, and probably the lead analyst, Chris Johnson, who worked for the CIA, they advise us at least monthly on the Taiwanese risk as they see it at the moment, and they don't think it's today's issue. Is their judgment. The second risk, I'd just say, just the power of the Communist Party in China, and any entity or individual who challenges the power or comes too large against that power will face a backlash from them. And that's exactly what happened with Jack Ma in Alibaba with the Ant-IPO. And we got caught up in that in November last year. We've reduced our risk around it. It's not like that risk came as a complete surprise. We just didn't think Jack would do something so stupid at that time, because he'd previously had a bit of runnings in and had backed away there. He must have thought it was his moment before Ant to really try and take the regulators on. He's paid a large price, and of course the shareholders have paid some price for that, because probably the regulatory crackdown has been harsher than it would have otherwise been. A lot of other companies have been caught up in that. And then we just get the regulatory side of things of China. And there's 2 things. There's what I call market efficiency regulation. China is very impressive on market efficiency regulation, what they're doing in the property sector, notwithstanding it's slowing down there. They want to get there before the ambulances come. They realise where there's risks in their economy, and also in the technology sector. It's not like China's just worked up and saying some of the technology companies are out of control and causing problems in competition and data and privacy and other issues. The whole of the world has woken up to that, and China has actually gone after each of those issues, and I think put in place very sensible public policy regulation, and in a very even-handed way. That doesn't overly worry us. But then there's social policy. China can be very, very brutal trying to deal with social issues in their economy, and it happened in the education sector, and it's potentially going to happen in the gaming sector, and that's why we're out of Tencent, because we don't know where that ball's going to land there. And then, of course, you have to make a judgment on the economy, and it goes in cycles, and China's slowing down because they're cracking down on various things. They've got a zero tolerance to COVID. Are we that worried about what happens in the economy in the next 12 months in our investment in Starbucks, or the fact that their restaurants aren't all open in the next 12 months? It doesn't really make any difference to our 5 and 10 year view on Starbucks. We're more worried about Taiwan than we are about the economy in the next 12 months in that. And it's really important when you invest in China that you have a margin of safety. Value really matters here. And also risk management. And that's been the real lesson for me in that. Don't think we don't have any risk management. We have huge amounts of risk management, but we had individual investments in China that were too large, and we had an aggregation risk in regulatory risk in technology platform companies. And we have dramatically changed those risk limits. And actually, we've done it outside of China in the last 12 months. We do a lot of risk management in our portfolio, but for various reasons, I can make excuses of why they got to it. It's because we weren't buying more of these companies, just their share prices took off. The year before, we had massive outperformance from our China holdings. And I'd also say is often we've held Alibaba. Often the best opportunities are found when it feels most painful in the short term. At the end of the day. And we've topped up a bit of our Alibaba holding. It's less than 4%. So I wouldn't say we're in any way going crazy. And I think people can rest easy that whatever happens, it's not going to have consequences. But if that sort of 4% position comes back and can double, we could make 4 or 8% return for people on their capital from that. And we saw it during Cambridge Analytica with Facebook, where people were literally urging us to sell Facebook during the heat of the storm. We did a lot of work and due diligence. We held our nerve and tripled people's money in doing that. So, part of our job is to do our homework and then work out whether it's a falling sword or a situation we should actually hold our nerve on. And we're holding our nerve on Alibaba.
Yeah, and so thanks for sharing all those risk management sort of positions. And so for the audience, so the position in Tencent, what was that position and when was that exited?
Yeah, it was exited in the last few months. Okay. In Tencent. And look, we made money in Tencent. We didn't lose any money in Tencent. We sold some of it near its all-time record. Then we sold the rest of it probably slightly above our average entry cost. The reason we got out of there is we still think there is unpredictable regulatory risk because they operate a gaming company, a gaming platform, and they also operate a social media and messaging platform. Clearly, they are in the more contentious areas, social media and gaming. Z is very concerned about children's time on gaming, and actually, as parents, you can actually have sympathy. Children's addiction on gaming is actually a genuine issue, and he's limited the amount of time that can be spent on that. But also you have 25-year-olds who are spending enormous amounts of time on gaming platforms, but they're literally addicted and they spend enormous amounts of money because the only way you win these games is to buy all the armor and the stuff that goes on in that. They make money out of in-app purchases. And if Z suddenly decides he doesn't like the gambling nature of this and there's no social utility, he could just ban at some point in the future in-app purchases in gaming, and it makes half the Tencent's money. And I've got no way of handicapping if we suddenly get an announcement one day the rules have been changed. And if it does, the stock price could be off 50%. And if he doesn't do it, it looks really cheap. And if he does do it, it's a falling sword. So I just go take some lessons. We took some lessons out of the education sector there. It's a very powerful platform. The WeChat platform, messaging platform is incredibly powerful. by the way. But the gaming business is something I'm cautious about in China.
The other thing you mentioned, Hamish, about Chinese government bringing ambulances. You've been there to sort of head things off. And a lot of our clients ask us about the property situation in China, Evergrande, what's happening there, and where do you see that, how that playing out?
Yeah, at the end of the day, I must admit I have a huge amount of respect for what the Chinese government is doing here. Clearly, they've got an overextended property sector, particularly with the developers who have taken on enormous amounts of leverage. And the lessons from the West is those are the types of things that could result in a crisis in your economy. So they've had people, from our understanding, we've got a lot of experts in China advisors. They've had people on the inside in Evergrande for a very extended period of time, and they've chosen to deflate the situation. So it's $300 billion worth of debt. And ultimately what they're going to do is effectively transfer all the assets out and get them completed. And actually there'll be some selective defaults on that. They think they can control the situation without dominoes falling in the rest of their economy. That's always the risk, that when you let debts default, there's something else that topples when you're doing it, and it's large and it's complex. But had that been allowed to collapse in an uncontrolled way, the Chinese government had the absolute choice. They provide all the liquidity in the economy. They could have just directed the state banks to keep lending to Evergrande, and they could have just pushed this problem off to another day. They chose to end the game, and they chose to then restructure and transfer these assets to other places. You know, the US put Freddie Mac and Fannie Mae in the financial crisis into conservatorship and bankrupted all the shareholders. Those companies are still controlled by the government effectively because they are systemically important. This is something that was so large and systemically important. The Chinese government has, at their own election, chosen to do it, and they're actually clamping down on rampant property speculation in the market. And you know, the latest saying that the government's saying is houses are there for living in, not speculating in, and they're cracking down on that. And as they crack down on that, it's going to affect the economy in the short term. I must admit, just letting things run completely out of control until there's a train wreck and dealing with a train wreck after the fact, is that a better way of dealing with these situations than them trying to deflate a situation? And even if it affects your economy's economic growth, you know, marginally in the short term, I'm one where I don't like everything about China, by the way, but you know, they've got some smart people, and I think, you know, doing things to head off systemic crisis if they can see them, and being gutsy enough to do that in the short term, I've kind of got some admiration for what they're doing here. But are we going to lose? Is Evergrande going to bring down the Chinese economy? I think very, very unlikely.
Thanks, Hamish. Earlier we talked about what's happened to markets, you know, how the big bull market since last year into this year as well. And you know, seemingly, you know, low interest rates are driving a lot of different valuations in stocks, and you know, investors willing to pay a lot. And you talked about maybe waiting for the tide to going out. But a lot of these valuations, whether you look at them on any measure, they're extreme, and some not even looking profitable at all in the future. You know, what do you think is the outlook for that, Hamish? Or do you think about that at all?
Look, I scratch my head when I look at what some people are doing in these markets. There are some great businesses, by the way, and some of these great businesses have gone from 35 times earnings or 30 times earnings, which we think is probably fair for some of them, and now they're at 65 or 70 times earnings. And people have them in their portfolios, and people are looking like they've done great things for their investors, writing something from 35 to 70 times earnings. There is no and I would put in something, a business like MSCI, which is one of the great businesses of the world. They own the indices. But for the life of me, I cannot understand how anyone other than speculation and sort of momentum investing is in any way could do any valuation and find that the value is there. And they're great, great businesses, by the way. But being in a great business and just riding a multiple expansion beyond any reasonable basis of valuing the company, I don't really call investing. at the end of the day. You know, the last week or the week before last, a great company we've all probably used, a company called DocuSign, where you sign your financial accounts or whatever on. Most people probably have done some DocuSigns because many people send them out now. It's a very, very good company. That was on very high valuation multiples, and it missed its guidance by a fraction in terms of what the market is expecting, and the share price fell 40% in one day. And I think the markets are littered with those examples. You know, Tesla seriously could plummet 50% in a single day on an event. And that would not surprise me. I'm not saying it's going to happen, but if DocuSign can go down 40% in a day, which is a very, very good business, and I could list you 100 of these companies which are unanchored by their valuations, then you get the ones that aren't earning any money at all. And you go, you know, there's just literally air pockets sitting between them and what their value. And this is why Charlie Munger was saying this is one of the most extreme markets he's ever seen in his life. And it's even great companies are getting caught up in this. You know, our decisions are incredibly analytical, and it's all based on value. I genuinely don't believe we have any air pockets in our portfolio of stuff that, because we sell things when we think they're getting expensive, and some of the things we've sold have just kept going up in these markets, and we're disciplined around valuation. So it's really important that you maintain your discipline and not sort of get envious by people who made apparent money of riding valuations into the stratosphere. You know, look what happened in 1999. People had their shirts ripped off. And, you know, if we have a correction here, you know, there are some places but also in the market, there is an incredibly crowded trade here around the economic recovery story. And, you know, if we get inflation or we get a major turn on this virus that the market doesn't like, or something else happens where some other major companies start getting into trouble and prices start plummeting, you have so many people who are doing the same thing that, you know, when they want to exit this party, they'll all run for the same door at the same time, and it's not going to be ugly. You know, I'm not saying it's definitely going to happen, but you can see scenarios where this is just going to be the case study in history, and everybody's looking at us because we're conservative and everything else and think we're bozos. All I'll tell you people are we're at intermission in this story, and the movie hasn't ended yet.
So on that valuation thing, you talked about your multiples moving out. These are, for the audience, price earning multiples, what you
price
pay.
Earnings multiple.
Yeah, for the future earnings. If you look at the global fund, the flagship fund, the Magellan Global Fund, what's the price earnings ratio at the moment when you look at the valuation across the portfolio, Hamish?
Yeah, on average, it would be in the low 20s on this year's earnings numbers. So, you know, given its growth and quality, I think we're in very middle of the sort of valuation field of what you would normally look at these businesses. You know, at the top end, we would have Microsoft that's trading in the mid-30s. You know, we made over 10 times our money in Microsoft. Microsoft is deeply, deeply advantaged for the next decade of what its likely revenue growth is going to be, which is going to be in the very low teens in our estimate, which is extraordinary for a company like that. But we have valuation multiples given the quality and growth that they're not like 35, 40, 50, 60 times earnings in what we're paying to own these companies. We've got others like Novartis that are at 12 times earnings. So we've got some stuff that's really cheap in these markets as well.
So the e-commerce sector is probably one where you find multiples expanded. Yeah. Can you talk about any particular stocks in e-commerce? You talked about a couple. What about Amazon, the view that Magellan have on a stock like Amazon, Hamish?
Yeah, it's really interesting, Richard. You know, we hadn't invested in Amazon for years, and it wasn't like we didn't understand the business. I think Bezos is one of the greatest businessmen in history, and I love the business. It's a more complicated business than people think it is. And I can go into what the investment case, but I didn't do it because I didn't have a good bearing on the valuation on it. I knew it was a great company, but we're not going to invest just because we think it's a great company. And I think the probabilities of making people money was high. But unless you really have an analytical view that you have some conviction around on the valuation, I go is at that point you lose discipline. As soon as you do it once, you then start lowering your standards and you start going into areas which you start using different techniques or multiples of revenue, or you start doing things where valuations could easily become unanchored. And we did so much work, and I got to a position of the work we did, which was extraordinary by our analysts, where we really became very comfortable about the valuation. And the reason it's complex is they've now got 4 different businesses and they don't give you all the information. They've got a very, very large e-commerce business, Amazon.com. They sell their own goods that they buy, but also third parties sell and put their goods in their warehouses. So you can buy it from first and third party. Then they've got the world's largest cloud computing business called Amazon Web Services. That is actually very easy for us to value. We've got a global cloud computing model. We invest in Google Cloud, Azure, which is one of the big Microsoft businesses, and AWS. So we've got a full global model. So we think we've got a good handle on the valuation of that business. But they're developing other businesses that are really, really important to the future of Amazon that really aren't earning a lot of money. They've got an advertising business, which is really starting to take off. But then they have 2 other businesses. One is their video streaming business. And their video streaming business, everyone thinks it's a free service with Amazon Prime, that you get your videos when you get Amazon Prime. This is where Bezos is such a genius. You know, he developed their cloud computing business using their data centers that we used for e-commerce, and he did it. No one saw him coming. So he leveraged his e-commerce data centers to develop a completely new business. What he's doing is he's leveraging his e-commerce users into a new video advertising platform. So he has 250 million users of Amazon Prime who use it really for same day and next day free delivery, but they get with us this free tack on video business, but they are now subscribers and watchers of this. They will, over the next decade, start buying up the world's sporting rights, in our view. And as they buy up these sporting rights, they will then have an inbuilt viewer base of at least 250 million people, and then they will be able to sell advertising. So if anyone watched the Australian Swimming Championships this year, it's interesting, Amazon Prime Video, it wasn't on Channel 9 or anything, it was on Amazon Prime Video. And even though you had it as a free service, it looked exactly like Channel 9. There were ads all through it. And that is what they're trying to do there. And there's $250 billion of advertising revenue out there for grabs in sort of television land. And that's what they're going, which is different. And we're big investors in Netflix, so we really understand streaming, but it's a different business model. So we've modeled that. And the next thing they're doing is they're now the second largest logistics company in the United States, I think, after the US Postal Service. They've overtaken UPS and FedEx now in deliveries of packages. But of course, they're delivering for Amazon.com at the moment, but they're wanting to set up a service that anybody who wants anything delivered, Amazon's infrastructure will deliver for any e-commerce provider. You don't have to sell on Amazon, and that's their big scale business of the future. And they'll end up having the lowest cost operations, and they will be the largest player in the United States and Germany and the UK. And the investment going, Amazon is spending in CapEx, and a lot of it's on their infrastructure. It's just breathtaking. Nearly $60 billion this year in US dollars on capital expenditure. And a lot of it's going into developing a business that people can't even see what they're doing. So we've modeled that as well. And so, it's taken us a lot of work, and I really believe it. So you're paying a reasonably high multiple of current earnings because they're investing so much in logistics and streaming at the moment. And those things are losing an enormous amount of money, but they don't tell you all of this. So you have to then work it out and do a lot of work. I'd say a lot of people who are investing in Amazon are investing in the story, but kind of have no idea what it's worth. They're just making it up.
Okay. So what's the value? What is the valuation of Amazon at the moment in comparison to?
I would say excluding the logistics business, it's modestly under its fair value, not substantially.
Okay.
And then it is how big the option value is on the third-party logistics business.
Okay. Thanks,
So
Hamish.
if it was really cheap, we'd have a bigger position, Richard.
Right. Okay. What we'll do, we will say to the audience that if anyone's got any burning questions there before I head to another question, we certainly have a little bit of time. If there's any Q&A come through, I'll watch out for that. But what I'll do is give people time to do that, Hamish, and see what happens there. But if we can sort of move into a question around Magellan's long-term objective return, 9% per annum, protecting capital. We talked about those things at the start. And obviously you talked about how you put the portfolio together with stock positions to help manage that risk, but also what Magellan did as well, and you can do, is move the cash position around. And last year the cash position was at a reasonable level, and some of that's been deployed. Would you like to sort of talk to us about your view on that cash position, how you do that, and where you're at the moment?
Yeah, Richard, it's a very good question. We don't use cash to try and time markets. We use it for risk management at the end of the day. It's a risk management tool, and we can go up to 20% in cash for those reasons. And we did something very unusual in March last year. We got fearful when others were fearful. And normally the saying is you want to be greedy when others are fearful and fearful when others are greedy. To some extent, we're a little fearful when others are greedy at the moment. But that back then we did the opposite of what we've done every other time. And I'd point out that Warren Buffett, I think for the first time I've ever seen in history, he did the same thing. He didn't use cash in March and April last year. He was selling banks and selling airline stocks and other things in his portfolio that have been very, very big holdings, and he sold them when the prices were down. And we sold things in that March, April period at the same time and went to cash. Why were we doing that? That for one reason only. The world was shutting down and we didn't know what was going to play out, and we were purely making sure we were preserving people's capital, that we were taking businesses out that had leverage. Businesses that were very like Starbucks and Yum Brands were selling down, but every one of their restaurants was suddenly closed and they had debt. And we said that was not something we were expecting to happen, by the way. McDonald's last financial crisis was the only two businesses and the Dow Jones went up, McDonald's and Walmart. And here we had a situation where they had zero revenue, and so we were really just acting in a way to make sure that if this really didn't correct quickly, we were going to protect people's capital at the end of the day. In hindsight, we would have been better doing nothing at all. But the pure mindset then was to do that. And we were in cash. And believe it or not, when it came to our strategy, materially outperformed the markets right until the 31st of October last year, 2020, during that whole downturn. And we were largely out of cash. We're at 5% cash, which I regard as sort of fully invested under the way we have our strategy. So actually the cash wasn't ultimately the drag on the performance. It was used as a risk management tool there. And we always think we may hold a bit more cash so we could hold some more high risk businesses like Amazon. Sometimes we offset the risk in that, or we use it as a tool to take down risk if we're really concerned around, because we can't short markets or do anything that's sort of black box. We're very, very transparent in what we would do, but we're not doing it because we can time them. I'm not going to cash now because I'm thinking, the market's going to have a downturn in the next 12 months. I'll sit in cash. That may or may not happen. I'm very confident in our portfolio, Richard, at the end of the day.
So it's more an extraordinary sort of period, and
we're doing it because we think it's the right thing to do to look after your client's capital, and we do it occasionally. And we've actually last year it turned out not to be necessary. I'm not sure if anyone can remember back in March. It didn't look like it was a completely unnecessary world we're in. Hindsight's a great. As I said, the best thing I could have done last year was be at the beach and do nothing at all.
Yeah, I know. A lot of people have got wonderful hindsight, haven't they? But being in the dugout back there in March,
it's really interesting, Richard. It's very important you don't get hindsight bias, but it's very important you also learn from the situations you were in. So you take lessons out of them, and that's really important. You don't want to reinvent history with hindsight and pretend it, but there were lessons coming out of a whole series of things that happened during the last 18 months here for everyone.
An experienced investor, someone who's had a few things to trip ups along the way, isn't it?
Yeah.
We've got a question, Hamish, from Chris Island, one of our...
Well, all I'd say is if our trip up is delivering 10 to 12%, and that's the consequence for our clients, I'd prefer that trip up than an alternative trip up of losing people money.
Yeah. Chris Island here said, Hamish, do you have any concerns about the inflated local residential housing market, e.g. 30% rise in 12 months? Any risk to the broader economy?
Yeah, it's a very, very good question. I think what's going on in housing is a very good indicator of just some of the extremities we're seeing. You know, you're hearing people listing houses with people giving, you know, I think compared to 12 months ago, particularly at the higher end of the market where there's been this massive sort of wealth effect. I got told a story that somebody in the eastern suburbs of Sydney had a house that they thought was worth 10 million. And the agent said, look, at the very, very best on an extreme day, you could get 15 for this house. And it sold within a matter of days for 25 million. You know, and I've heard so many of those stories where things are just at, I don't know where all this money is coming from, by the way, but just extremely crazy behaviour. So, and of course, the whole market has inflated itself relative to people's wages. Housing, of course, when interest rates are zero, but if we do get if inflation is the problem, and I'm sort of sitting on the fence on that, but if it is the problem, it is super ugly for house prices because we're going to have a tightening of monetary policy. And at that point, I think some people are going to be stuck holding stuff that they can't afford here. And housing is very, very important for the economy. What they're trying to do is a very, very easy glide path out of this extraordinary situation with tightening monetary policy or interest rates very slowly. But if this abruptly came to a halt, we know how important housing is in terms of the wealth effect of economies in the market. And it is disturbing what has happened in the last 12 months after a period of 20 years of ever increasing house prices. And, you know, I don't know when, but this could be one of the stories that you know, I'd be the person who thinks you should pay twice for a house than it was worth 2 years ago and thinking that's a good thing to do because interest rates are low. It's just another sign that there is some unanchored behaviour going on at the moment. And that's why I say this movie hasn't ended yet. But if people aren't reading some of the signs of extreme behaviour, especially if, you know, you only have to look in the housing market to see some, and everybody will have a story, I guarantee you, of something they've heard extraordinary that's happened in housing in the last 12 months.
Thanks, Hamish. I don't think we've got any other questions. Anyone from the investment committee want to proffer any questions while we're there? Mike?
Thanks, Hamish. Tremendous as usual. Good to see you again. Probably my only question is your discussions with your Chinese investments. You know, obviously from the outside looking into China, the diatribe that the central party wants to portray is fairly controlled. When you're dealing or talking with the companies that you invest in, what is their reaction to the impositions that the government's imposed upon them?
Look, I think they're realistic about it. So they're not. They're certainly not putting out a line that none of this is real. You know, they're putting a reality on it that and maybe it's a thing because they have to be. They're respectful about what's happened. I think it's had harsher than they expected it was going to happen. But they're getting on with it, and they're reacting to it. And I think you'll find places like Alibaba, I think they're going to start to list and bring investors in some of their big businesses that are unprofitable at the moment. I think that will please the government that they're effectively untying part of this, I think that will give us transparency and valuation. We don't only get our information from what Chinese companies, and obviously they're limited to some extent what they can say. I think we have to be realistic in what the Chinese companies can say to us. I think they're being realistic, but obviously muted to some extent. They don't want to be critical at all, and therefore, when they're saying they're accepting, is they probably have to say that we've got some incredible advisors who advise us on China. Chris Johnson, who is the lead analyst at the CIA, has given us enormous flavour and someone we don't advertise. We've got another group, John Garneau and Nat Pottinger. John he worked for the Turnbull government, and he did all the work on Huawei there, and he gives us a real interpretation and his view of everything what the Chinese government is meaning and they're saying, and they do a lot of due diligence of the underlying companies for us and opinions, So we're trying to get as much information from speaking to the companies and probably speaking to some of the world's most foremost experts who have spent their whole lives in analysing this risk and what's going on, and we just try and take it all into account into our decision making. And all I'd say is, even taking it all into account, it's still hard. We have more paid expert advice on this than most people would have, and even then we find it hard.
Okay. I think, look, Hamish, thank you very much. I think we're out of time there. So I'd just like to say, on behalf of FMD and the Investment Committee, thanks very much for your time today and to taking the time to speak to our clients. And to everyone watching, FMD, all clients of FMD and those watching today, thanks very much for joining us. I hope you found the talk from Hamish very useful. It's very insightful. And so we'll bring things to a close. But thanks very much, Hamish.
An absolute pleasure. And I hope everyone has a very safe and nice Christmas and break over the period. It's been a tough year for many people, with lockdowns and everything else. And I'm sure people are wanting to spend time with family.
Has been indeed. And my sentiments indeed. Thank you, Hamish. And farewell. Thanks, everyone. Bye for now.